Morning, Top Gun here, 3:45 a.m. Pacific Standard Time, Friday, March 12th. This is the YouTube pre-market commentary. Okay, growth over value. So for the second time this week, yesterday, growth trounced value, reversing a trend that we've seen of value trouncing growth over the last month. The S&P Growth ETF, IVW, was plus 1.90%, while the S&P Value ETF, IVE, was only plus 0.05%, essentially flat, and it faded very hard after being up in the morning throughout the rest of the day. So it was a growth day. The S&P was up 1.04%, the Nasdaq led up 2.52%, and the Russell was up 2.31%. Now, the bounce of the overall market that started last Friday morning, and which is now being led by growth, has undone some of the technical damage of the previous 3 weeks. In fact, the S&P closed at a marginal new high of 39.39 yesterday, 4 points higher than the previous high of 39.35 on Friday, February 12th. Now, the Nasdaq snuck just up above its 50-day moving average, so that's repairing some technical damage too. Only 41 points above it, so precariously so, but it still remains about 5% below its all-time high from Friday, February 12th as well. Okay, now the leading ETFs of the bull market, the QQQ, the SMH, and the ARKK. They're all still below their 50-day moving averages, and they're also well below their all-time closing highs, with the QQQ being 5.47% below, the SMH 8.71%, that's the semiconductor ETF, and Cathie Wood's ARK Innovation ETF, ARKK, 17.82% below its all-time closing high. Okay, so you can see all the charts in the blog post. Let me just scroll through here. Okay, so taking all of this together, it looks to me like a bounce for growth/tech rather than a resumption of its leadership to me for now. So, and because growth in tech makes up so much more of the market capitalization of the major indexes, if that interpretation is correct, the bull market is likely topping because value cannot carry it higher without growth. Okay, I want to point out a nice discussion of the growth to value rotation in a blog post by Greg Reben titled, "Is It Too Late to Rotate?" That appears to be written Thursday morning. It doesn't discuss yesterday's developments, but it's really good about thinking through the interpretation of the rally that we've seen over since Friday morning at I think 8:30 a.m. Pacific Standard Time when the market bottomed and rallied hard the last 4.5 hours of last Friday. Okay, so obviously we're not going to know which interpretation is right. The market's going to tell us by what it does in the coming days and weeks. If in fact growth is resuming leadership, the bull market can continue. If this is just a bounce, as I believe, and as I expressed yesterday, by selling our long ARKK trade that I put on Monday at a nice profit, and I flipped short ARKK 15%, QQQ, SMH, and IWM 7% each, so for a 36% short position. Okay, so now that we've reviewed the technical picture, let's look at the fundamental picture, because there were two important earnings reports yesterday that are going to shed some light on our understanding of the overall market. The first one was DocuSign, which reported a 57% increase in revenue and non-GAAP diluted EPS of 37 cents. They also provided guidance, line item guidance, what margins are going to look like, what revenues look like for 2021. And if you do the math, it looks like they're guiding to $1.28 in non-GAAP EPS. Now the stock when I was writing the note was at about 214. So we got a price to 2021 guidance ratio of 166 times. So I like to divide the market up into mega cap growth, speculative growth, reopen value, and defensive value. Now, DocuSign clearly falls into speculative growth, and it's no surprise that it's the 15th largest position at 2.02% in Cathie Wood's ARK Innovation ETF. Okay, so that gives you some insight in, we've seen what ARK's been doing technically, and this gives you an insight into the kinds of stocks that are held in her portfolio, which I call speculative growth, and which are insanely valued, and therefore extremely sensitive to rising interest rates, because their earnings are so far, their projected earnings are so far in the future, and therefore have to be discounted for many years. Okay, turning now to Ulta, it reported comps of minus 4.9%, and it guided 2021 diluted EPS to 885 to 930. So at its current pre-market price, when I was looking an hour or two ago, and giving it credit for its $1 billion in net cash on its balance sheet, Ulta has an enterprise value to 2021 EPS guidance multiple of 33 times. Very expensive for negative 4.9% comps, and it's basically priced as if we're already having a full recovery before that in fact has materialized. And that's representative of the reopened value category, my term, as a whole. Okay, so to sum up, we got a mixed technical picture that looks to me like a bounce, but could be a resumption in tech leadership. And which interpretation turns out to be right is going to determine if we're topping or if the bull market continues. Turning to the fundamentals, what DocuSign, a representative of the speculative growth segment, and Ulta, a representative of the reopened value segment, show is extreme overvaluation in those two segments. And you also see that in mega cap growth. The only place where you can find value is what I call the fourth category, defensive value. And that's where all of Top Gun's stock holdings are. Stuff like Walmart, Procter & Gamble, Clorox, Kroger, AT&T, those types of things that are defensive and are not interesting to people right now, but where I see the value in the market. So these valuation levels are sufficient for a top, but of course the market can do anything. So whether that is in fact the case is to be determined. Have a great weekend. I will see you guys next week.